rates are everything. We know that. When we have low rates, we enjoy a market rally. When we have high rates, the market declines. In fact, they spent $114 billion in 2008 to prop up the banks, right? To get the rates down, to move these banks up. $114 billion, get the rates down. Another $27 trillion when they're doing QE to get the rates down. See, that's how important it is. $27 trillion to get the rates down to rally the market, right? But what happened here? Let's take a look at the chart. In 2008, the market went from near zero, less than 1%, 0.16, for 14 years. 14 years, this market rallied up 590%. And the rates were at below 1%, near zero, all except for 19 months. Between June 2017 and 2019, they went up to 2%. And immediately in May, they dropped them back to near zero. So near zero rates are a good thing. Look at that rally. And then the opposite happened. All of a sudden, rates started to go up from 0.8 to 3.8%, almost 4%. Well, that's not good. The market went down. That all makes sense, doesn't it? But then this is when it gets curious. From October 2022, after a 25% drop in the market, after we had a 590% gain due to low rates, those high rates gave us a little damage here, didn't it? 25%. So the rate's now at 3.8%. What happened next? Well, the rates went up. They went back up again. Okay, so they went from 3.8% up to 5%. Oh, the market should be going down. But guess what happened? It turned around and went up. Wait a minute. Went up. In fact, in March of 2023, when the banks collided, remember the three big banks, the three regional banks went down. Look at my chart right here. Now, you would think, after all, with three banks collapsing and then another 180 banks ready to collapse, the market would go down. It continued to go up. The market went up 28%. And then, at 5.1%, all of a sudden it dropped again. Well, wait a minute, that made sense because the rates were high, 5.1%. And it dropped all the way down to October 2023 because they remained at 5%. Now that makes sense, doesn't it? Rates high, market drop. Rates high, market drop. This gets real crazy now. In October 2023, after we had the sell-off, about 10% on high rates, over 5%, the market then turned around and rallied. That's right. The market started to rally. But wait a minute. The rate stayed at 5.3%. Weren't they supposed to go down? Sure, they should have. But they went up 15% to 2024 January. Hold on. What's going on here? Wait a minute. If rates were at 5% and they declined 10%, and the rates at 5% went up 15%, how could the market go down and then up at the same rate? I'm going to explain. Well, let's go back. Now, we know that the rally from 2008 to 2022, January, made sense because the rates were low. How that happened? They spent over $114 billion going in and saving the banks to drive rates down. Another $27 trillion they printed and pumped in to get rates down. And then when the rates started to go back up, the market pulled back, just what you expect. But how did the market go up when rates were going up? That made no sense. Well, let's look into it, especially when the banks blew up. What the Federal Reserve did is they printed a whole bunch of money, put it in a pool. And they went to the four largest investment banks who they control and said, what we want you to do is buy Apple and Microsoft. Buy them for us. We'll put them on our balance sheet and buy them for yourself. We need this market to rally. Why do they need the market to rally? Because they knew a banking crash was about to happen. They knew that the banks were in trouble. The regional banks were in big trouble. They knew the Silicon Valley Bank and First Republic and Signature, and they knew there's 180 other regional banks in trouble. So they wanted to rally the market before that news broke. Here, take a look. So the March banking, right here, the March bank, they all blew up. Those three blew up. March 2023. So how they kept the market going up to get through this is they created a pool of money. A pool of money. And they said to the 3 or 4 biggest banks, investment banks they control, hey, just buy Microsoft and Apple, buy it for us, the Federal Reserve, we'll put it on our balance sheet and buy it for you. And the market would rally and go right through that banking crash. Nobody would think anything of it, and that's what happened. And that's how they got that fake rally. And then it did what it was supposed to do to the market with that high rate, finally collapsed. Well, how did it go up again from that October 2023? They must love October, because every October it seems like they rally the market. How did they get that to rally up at 5% when it came down at 5%? They did the same thing. They put another pool together. They did Microsoft, Apple, and I forgot there's one other stock. So now let's go to where we are today. They're telling us the market's going to come down. I mean, the rates are going to come down. They're going to cut the rates. But wait a minute. What's going on? Well, one thing they don't want you to know is they can't cut rates right now because they got a real problem. And what's that problem? I'm going to show you right here. The problem is they've got a pool of money. It's called the money center, okay? Or money supply. Mostly everybody calls it money supply. There's the money supply, and it's loaded right up to the top. But production is like that. We have far more money than production. What happens? Inflation's going up. And that's why they couldn't cut rates. That's why they couldn't cut rates. And they left the rate stay the same, and they rigged the market to go up by doing another pool like they did here. So now we're at the end where all of a sudden the market's starting to sell off because of the rates. But they're telling us, no, don't worry about it. They're going to cut rates, maybe even 6 times. They can't. That's why they rigged the market from 2022 October to July. They had to have a pool of money to buy Microsoft and Apple to move the market up against high rates and move the market up against high rates again between October 2023 and January 2024. I want you to really think about this. If you just take for evidence, this evidence right here, how on earth would the market drop at 5.3%, which it should, but how could you justify it going up at 5.3%? Wouldn't you be embarrassed? Well, they're not embarrassed because nobody knows the difference. They don't know the pools they're making. So now the market's starting to come back a bit. And every time it comes back, they try to push it right back up, using those tech stocks again, and they can depend on the tourist investor because he's going to buy every dip he can find in these tech stocks. Well, I'm going to tell you right now, the economy is in bad shape. We know that. We know that our debt is just horrendous. Our national debt is up 200%. 266% since 2008. Our annual interest rate since 2008 is up 114%. Imagine that. Our deficits, those are even gotten crazier. They're up big time, the deficits. The deficits are up 340%. By the way, I hope you do me a favor while you're listening. Hit subscribe, like, and share. It really would like to have you do that. So we got some real headwinds, don't we? We got some real headwinds. Now, the other problem that we have is that the banks, in March, 180 banks, regional banks, remember when they went in, the Federal Reserve, and made a big pool of money so the CEOs of the 180 banks could go in when their customers said, hey, I'm leaving, I want my money? Remember what happened with Silicon Valley and First Republic and Signature when the clients went in and said, hey, I want my money. There was no money there. They didn't have any money. Well, to stop that happening with 180 banks, the Fed turned around, printed money, and said to the 180 CEOs, come to the window at the Fed, we'll give you the money. But what did they know? They knew that the customer would take that money and would loan it back to the government at 5%. 5% rate for 3 months. But now comes the problem. In March, all those mortgage-backed securities and all the treasuries that the Federal Reserve purchased from these banks to keep them alive are due. The banks can't buy them back. The banks are broke. So they got to make a decision now. Are they going to go back to QE? So if you look at my chart and think about what they did, they rallied the market from 3.8 to 5. When rates were going from 3.8 to 5%, they didn't care. They did a pool of money and did QE is what they actually did. And the banks participated in it. Will they do the same thing? Here they did it again. Rates went from 5% to 5%, but the market rallied. Are they going to extend the market again? Another 15, 20, 30, 40% by doing it again. Now, if they do that, do you know what would happen to inflation? You'll be paying $25 for a loaf of bread. So they're in a pickle. The inflation's not 3.5%. Inflation is more like 10 to 12%. Everybody knows that. So they got a real problem. So they're going to have to make a decision. Members of Congress, the Senate Bank Committee, the Housing Banking Committee, are they going to work for you and I and do what's right and let the market finally correct itself and get rid of all this debt they call it and let it go into a much needed recession? Finally clean this mess up after all these years? Since 2008, we never fixed the banks. They're still not liquid. They're still insolvent, rather. Or are they going to continue and say, you know what, hell with that. Let's do it again. Let's do another QE, and we don't care if interest rates go up because inflation will go up. And we here at Congress are doing a lot of inside trading. We're going to get rich because we have a lot of assets. We own agricultural land, we own timberland, we own artwork and diamonds. What do we care if inflation goes up? Let's do it. Let's do another QE. The hell with Main Street. They could do that. But I don't think that's going to happen because inflation would be so terrible, so obvious. But again, we're in an election cycle. Could they do that because it's an election year? The Democrats are holding the White House, Senate. They don't want to lose. We don't know. But what we do know is this. When rates go up, the market goes down and vice versa. And when they don't do that, then there's funny business going on. But that's okay because here at Phil's Gang, my members, they're going to know exactly what to do. No matter what happens, up or down, high rates, low rates, they're always going to be on the right side of the trade because they have the skill to read the bond market, which tells you the future direction of the market. Always does, always has. And they know how to sell short as well as buy stock. So won't you join me here at Phil's Gang? Love to work with you. We're offering for 10 days free. Free, don't have to pay a cent. Learn how to short a stock. Learn how to bond market. Free, 10 days. Just click the link to my bio. I'm really looking forward to you joining the gang for 10 days. And by the way, at the end of 10 days, you decide you don't want to stay, or maybe you say it's too much for me, I don't have the time. That's okay too, because you can just stay with our Spider program. You know, in the last 30 years, the S&P went up 10% a year on average. You don't make that kind of money in your 401k. 10% a year. So if all you did is stay with our Spider program, where every day we tell you exactly what to do. Buy, add, don't add. That's a great program too. So that's it here at Phil's Gang. So click the link in my bio. I'll see you on the charts.